Who would get hit badly by this news? Home builders. Rising interest rates often lead to higher mortgage rates, which potentially crimp the home builders. So you see a sell-off here. And there's one other major development moving the ground under Wall Street's feet at this hour. Let's get right to the floor show. Joining me now is B. Riley Wealth's Chief Investment Strategist, Paul Dietrich, and Annex Wealth Management's Chief Economist, Brian Jacobson. Guys, it is that the longshoremen have agreed to go back to work at the East and Gulf Coast ports after just 3 days of striking. And I think we've got a live picture right now. This, what you're seeing right now, is a picture of Fort Lauderdale's port, where union members are now unloading the dozens of ships that have been idling offshore while the union and the shippers faced off. But last night they came to a tentative partial agreement. Turns out they agree on a 62% pay raise over 6 years. Paul, I'll start with you for the moment. Markets are taking this and the jobs number as good news. As someone who tactically buys stocks, do you take it as good news and jump all in? How do you react to this?
Definitely not jumping all in. I looked at and read the entire jobs report this morning, and if you look at where all the jobs came from, they were really at the low end. This was not the greatest jobs report, but also this month, for the first time, manufacturing has been in contraction for well over a year. But for the first time in September, we saw the ISM employment for services going down. And the last time that happened was 2007, right before the recession. Historically, that's been a recession signal. It's true that the government jobs, a lot of that was last minute spending on things that on September 30th, they had to all go.
Is this your base case for not jumping into the markets at the moment?
Yes, I think this employment.
Let's show the markets if we can, so we can see what's going
these employment numbers. Last month we had a bad employment number, and the Dow Jones just sank. This month we had a better than expected jobs number, but you're seeing basically a kind of a mediocre response from the stock market.
Brian, together these headlines about the port workers going back to work for the time being and the jobs number, they are positive for the short term. What about the longer term?
Yeah, it was two October surprises, I suppose, right there, as far as the 90-day abeyance with the port strike that's just been punted to the next administration as far as January 15th. And then you have the jobs numbers, which were really good. When you dig into the details, though, I'm not sure it's as good as what it looks, mainly because you had some seasonal factors. So these are seasonally adjusted, and the September seasonal adjustment factors have pushed up the actual number. Plus, we also know that the BLS, they have this birth-death model where they try to guess how many small businesses are creating jobs because they don't directly measure that. And they already told us back in August that they're overstating payrolls by about 68,000 per month. So when you kind of adjust for the seasonal adjustments, that birth-death model, it's a good number, but not outstanding. I'd say happy days are here again for now.
You're saying that the Wall Street Journal, when they call it a blowout, is wrong?
No, it is a blowout number as far as how it's published.
Brothers here in this building.
Yeah, with that headline number, it is indeed a blowout. But as with most things, reality is probably a little bit softer than what it looks. We have a very low hires rate, a very low layoffs rate. Something's going to give. And our guess is that you're going to see the layoffs rate begin to pick up a little bit before the hires rate does, which means that this number was great, but November 1st, right before the Fed meets, maybe we'll get some payback.
Paul, you have said the worst thing to do right now is to pile into the overvalued stocks, the crowded areas. Does that mean the chip stocks? Because people are jumping into those today.
Yeah, I mean, people forget that the most profitable .com companies, internet companies back in 2001 and 2002, Microsoft, IBM, all of the tech companies, they all lost over 50%, 50 to 70%, even though they had great profits. If we go into a recession, and unless you believe that the entire business cycle has been repealed and we're never going to have a recession again, when we go into it, everything is going to fall, including the best stocks. I mean, Amazon was down 92.5% back in the dot-com recession. Microsoft was down 74%. Apple was down about the same amount. They're all going to fall with those, and partially they are overvalued. This is the most overvalued stock market that we've ever had. Period.
Okay. Well, in the aggregate, I mean, there have been pockets, certainly. But Brian, where would you advise your stock team? Because you, as the economist, I know, probably talk to them often. Where would you advise them to tell the clients to go right now?
Yeah, and in fact, we were talking about that just before this as far as what are we doing? So first, we're looking at adding duration. So on the fixed income side, we thought 4.5% was too high for the 10-year, 3.6% was too low. Now we've had a big move up, so now we can add a bit more duration. On the stock side, believe it or not, we do like industrials, financials, healthcare. It's kind of a mix of some cyclical, some defensive, but mostly driven by a view of price. What's the valuations? Price relative to those earnings. And so I agree wholeheartedly that there are areas that are overvalued, but there are still opportunities to be had.
Yeah, here we go. We look at the 10-year yield at 3.986. You could call that 3.99 at the moment, very close to 4%. Good to see you both. Paul, Brian, thank you so much.